Hi, I'm Peter Rose, founder of Longwood Currency Trading. Should you pull your Forex profits or should you reinvest them? When we're looking at trading as a generic thing that we do, we're looking at maximizing the amount of money that we make for spending, and we're trying to maximize that money to the extent that we're building wealth in the background. Now, if you're under probably 30 years of age and listening to this, you're more concerned with that making the money thing. And that's why I tend to I guess, resonate with the 30 to 50-year-old group better, because I spent 40 years invested in real estate and walked away from that a millionaire. And so my view of things tends to be more mature and reasonable and pragmatic for folks. Whereas when you're younger, you just want to yahoo and throw it against the wall and make it happen. And I understand that. But if you get a bad taste in your mouth for trading because you lose stuff because you do stupid shit when you're young, you'll go on and you'll trade crypto, or you'll give it all up and go farm on a commune in Vermont or something. I mean, I don't know what you're going to do. But once you get to about 30 years of age, you're working a job and you have responsibilities. You're paying your own mortgage, rent, food, and all that other sort of stuff. And you have a different view of life and what your needs for money are. You have a job, and so therefore, it isn't imperative for you to replace your job immediately. You want to do it right so that the money that you make will eventually replace your job, and you can trade full-time based on that. So the statistics, you know as well as I do, are 90% against us as retail traders. 90% of that reason is because we don't have the proper education and the confidence in that education and in what our abilities are in order to differentiate between a trade that's gone bad and one that has some life left in it. The criteria there is to get out of a bad trade. And I've done just tons of videos about that, and they have to do with risk management, right? So when you're looking at pulling your profits or whether you're looking at reinvesting them, probably as the younger traders that I've talked with, the under 20 group, they're looking to make a lot of money so that they can not have to get a job when they get out of college or whatever it is that they're doing. And so you're basically pulling your profits. You make $500, you get lucky someday on your $10,000 account, you make $500, 50 pips, and so you go spend $250 of it and take your friends to drinks and dinner. When you get to be 35 or 40 years of age, you're not so eager to pull those profits because you understand the powers of compounding. And then over a 20-year period of time, not that it takes you 20 years to make a lot of money in Forex, but it takes a lot of time to build enough money to provide a passive income growth for you. That's why you put your money when you're working, you put it into a 401k so it grows tax-free, so that in 30 years or 40 years, you've got $300,000 or $400,000, $500,000 in that 401k. You start taking your RMDs, and at 4% pull on a $300,000 account, you're pulling, $12,000 a year, $14,000 a year. And your Social Security is another, $20,000 a year. And so you're doing okay. Your house is paid for, and, you've satisfied all those goals. That's where we're all trying to get to, so that when we retire, the assets that we have are going to sustain us through the next 30 years. You're going to work for 30 years and then you're going to be retired for 30. So or 40. I mean, the lifespan is constantly increasing in the developed countries. And so we can expect to live beyond 70 or 80 years of age. And there's so many people now that are 100 years old. And that's not so rare now. It's rare because there's hundreds of them as opposed to bazillions of 60-year-olds running around. But you get what I'm saying. What I'm talking about is really planning for the future. When I'm working with a student in my fast track course, it isn't just about pushing bid ask. It's about what kind of foundation are you trying to build in your trading. And the foundation that I'm preparing you for is that you build and you reinvest so that you gradually build over a longer time frame, 5 years or 10 years, to gain the confidence where when you swing for the fence, you've got enough money in that account that it really makes a big hit. You make a 5x pull or make a 10x pull. But a 5x pull on a $20,000 account doesn't have the same effect as a 5x pull on a $200,000 account, right? And so you have to understand proper risk and money management if you're in there for the long pull. If you're just in there for the short pull to make $20 or $30, $40,000, and you're smart enough to go, oh, okay, I made $20 or $30, $40,000, but that earnings isn't really based on foundational risk management, I'm going to pull my 40 out and that's it. And I'll take that 40 and I'll buy an investment property, or I'll put it in T-bills at right now 4 point something percent or whatever that happens to be. But for those of you that are looking at serious trading, then you have to look at it differently than if you were 22 years old, even if you're 22 years old. Look, I was 22 years old at one point. I was just talking to a guy the other day who's 24, and we're talking about currency trading. And I said, you know, when I was 24, I looked at the market out there, and I said, what am I going to do with the college degree that I have? And how is that going to prepare me for what's going to happen, 40 years from now? And I was able to make those sorts of decisions because my folks were older. They had me when they were in mid-40s. And so I was able to watch them work their lives and retire and, no debts, no problems. Needed to buy a car, you buy a car, and everything is okay because the money is there on an income basis from Social Security and just general savings, and then from retirement, and they had pensions then as well. So they were doing fine. So in working with people, I need to understand what their goals are and to then talk to them about how I would use this fast track manual and then craft a program for them in consulting that would be most beneficial to bring them to what their goals are. And then you can make the decision as to if you're going to pull your profits. If you are, what percentage of profits are you going to pull? When would you start pulling profits as opposed to your constant reinvesting and then compounding against that reinvestment over the long term if you're looking at doing trading for the long term? I mean, if you're coming to me at 60 years old, that's a whole different story. You don't have 10 or 15 years to compound and to grow wealth. Your trading will have to be more risk management focused and geared toward more aggressive investing to compensate for the fact that you don't have a large amount of money, that you're compounding larger and larger amounts of money. You might only have $30,000 or $40,000 that you can invest at that time. So you don't want to lose it because you don't have the job to make the income to replace that. You would have to replace that out of your savings. And if you screw it up again, now it's $60,000 that you've lost. So you don't want to get involved in that. So the risk management becomes just really, really, really critical. And then you look for those opportunities where you swing for the fence safely and you got your foot on the brake all the time, and so you can close the thing down when it starts to go against you. But we do that anyway in our general training for people. That's how you trade. You develop through your trading metrics how you are, what your expectation is. And then based on that expectation, which if it's tempered the way that I present building rules with metrics and determining expectations and stuff, you have what we call a baseline expectation. In other words, based on your current experience, and that's, you're going to do a 6-week program and we're going to have a baseline for you. Now, whether you continue that baseline out or not, you're going to like that baseline. So that's the one that you're going to continue working on from that point on, so that then you begin to invest more money into that and compound and build and grow from there. So when we're looking at building risk management rules, I have to know what your intent is. Because if your intent really isn't, let's say you're doing fairly well at your job, so you're in control of your situation. So that changes the dynamics totally as to pulling profits and reinvesting, and what are the tax consequences of doing something? Are they going to affect what you're doing? All that sort of stuff. So that the decision that you ultimately need to make between pulling your profits and reinvesting becomes a collage, and which can change over time based on your rules, the size of your bank, the amount of money that you made this month in relationship to the money that you made before, that sort of thing. All right, so that's the main thrust of pulling or reinvesting. If you are trading in prop, which I do not suggest that you do, and there are many reasons for that. If you'd like to chat with me about that, I'd be happy to set up a video conference with you and we could talk about that. So if you are trading in prop, probably the reason you opted to trade in prop was because you didn't have any money. So if you don't have any money, then you're gambling. Because the currency market is not someplace where you go in with a $500 account or a $200 account or a $15 account. Because you're learning, first of all, by trading those small amounts of money, you're really not learning how to trade. You're learning how to gamble, because you're probably trading at 200 to 1 or 500 to 1. That's what folks do with small amounts of money, because they're trying to grow the money instead of thinking about making a lot of money. They're thinking about making a little bit of money. $500 to a couple of $1,000, clean the account out, start over, $500, clean the account out. You can do that a couple of times a year, maybe 3 times a year. So you make $10,000, $15,000, but that's not going to replace your job income. It's not going to impact your lifestyle in the long run, and you're spending that money rather than reinvesting it. And you can't reinvest it in the prop because you're working against your drawdown. That's prop. The rules of prop are different. So if you're trading in prop, you're not trading in the Forex market. You're trading to fit the guidelines of the prop firm. You're not trading any of your rules or any of that, because your rules have to be geared to fit the criteria that the prop firm puts on you. However, if you don't want to hear that, you don't want to listen to that, and you're trading prop fund, then you never reinvest, you always pull. And there are reasons for doing that, and there is methodology for doing that, but because I don't believe in prop, I'm not going to talk anymore about that. So that hopefully from this video, you've got an idea that those are two real important concepts that you need to think about as you're starting to get going in your trading. Or if you're 2 or 3 years in, most of the folks that I talk with have a couple of 3 years of trading experience. So you're not coming to this stuff cold. You've been around the corner before. So this will make a lot more sense to you about, well, how do I determine how much and when I could pull some profits out and yet reinvest the balance? How do I compound that? How do I build that compounding? And how do I determine how much of that profit I should be pulling out of that account? And that's all based on you and I talking about what's the long-term goal. Now, that long-term goal could be a 3-year period. It could be a 15-year period. So the long and the short of the thing, should you pull your Forex profits or reinvest? And the answer to that, it depends on everything I've said in this video. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.